Right, over to you.
Okay, well, thank you very much for joining me. And in absentia, let's say thank you very much to Sunny Basra, my colleague, who set this up. Um, so I work for Vanguard. I'm going to talk you through a couple of important ideas, I think. Before I do that, and maybe put a hand up or whatever, are any of you familiar with Advisors Alpha? Is it something you've even heard of before?
Uh, I have
Okay.
previously.
Good. Well, there's only a few of us on the call, so keep it interactive. Let me know if there's anything that's unclear. There should be some slides that's sort of in front of you. I am quite fast, so just interrupt if anything is unclear. Okay. So very quickly, I'm in a small team of 4 people in London. We do 3 things. We work on essentially Vanguard research on investing, which is what I'm probably most expert at, practice management, and financial planning. And just so you know, I spent more than 20 years on Wall Street. I spent 15 years in New York. So my background is very much on the investing side. Um, Today, we're going to talk about Advisors Alpha, which is the top left. We work on a number of other things. Again, I don't know your network that well, so please, tell me what might or might not be useful. But we're going to do 2 things today. We're going to touch on Advisors Alpha, and bottom left, we're going to touch on equity market concentration. And as I said, needless to say, we spend all our lives working, so there's a lot more here, including my colleague who does primary research, surveys, that sort of thing. So Advisors Alpha is this idea of putting value on your value, and we'll try and explain what this is. These papers have been downloaded more than 8 million times in the US. So Advisors Alpha is a very big deal in the US, and we have got a UK paper if you want to read, a PDF, and then of course, that's what I'm going to show you today. If you haven't read it, I thoroughly recommend over the summer, No More Champagne, the history of Winston Churchill and his money, because he always struggled with money. And I guess our point would be if even Churchill, with all his privilege, could struggle with money, everybody can. And what you see here is this idea of the concept of Advisors Alpha, which I'll be going through. The idea here is that this is not just about managing money, right? Really, you're managing people. You're in the people business much more than you're in the financial business. So yes, there's investment management, that's fine. But really what you've got here are other things, wealth management, service, and of course, behavioral coaching, which sounds like yoga, but is quite an important concept. And so, with all American presentations, we have to kind of lead with the conclusion. The conclusion is that these 7 things, asset allocation, costs, rebalancing, asset location, obviously important, SIPs, ISAs, pensions, all that stuff that you do and know like the back of your hand, spending strategies, how to spend the money in retirement. Do I get an annuity? Do I do this? Do I do that? Total return investing versus income. We know psychologically that people struggle sometimes to spend out of capital, and then behavioral coaching, which is kind of linked to all of this. So when we sum it up, Advisors Alpha is, as I said, probably why it's been downloaded 8 million times. It suggests, with a lot of analysis, that the difference between an advised client by you and a self-directed client is 3% net per year on average. So there are years where lots happens and you add a lot more than this. COVID, 2022, say course. And then there are years which are, relatively placid. And what you will also see is there is numbers of zeros on this. Why is asset allocation not more than 0? Well, we cannot measure this accurately per client. And Vanguard, if you know nothing more, even if your Wi-Fi disconnects, Wi-Fi notwithstanding, Vanguard is a very conservative company. Okay, yes, we're American and all that kind of stuff, but it's the most sort of cautious American company you've ever come across. I've worked 25 years elsewhere, Morgan Stanley and Sanford Bernstein. Vanguard is it's like nothing else. Okay, it's not our money. It's client money, and we take that very seriously. The way that translates for you, given that we only got to the UK in 2009, is that we have everything triple checked by compliance. So we're not into outlandish claims and fun. right? We're not taking anyone to the rugby, okay? It's a very different kind of firm, right? Built for clients. So what I'm going to do is take you through 3 of these 7 things and explain, how we come up with these very high numbers, given that many of you will only be charging 1% per year for your advice. So you're well worth your fee. We did a survey called Client Connect, more than 1,000 advised clients in the UK and 200 advisors. That is available if you were interested. When we asked the clients what they thought the value of their advisor was, it was 6.5%. Now, clearly, to me, who's been in markets his whole life, this is absurd. But it doesn't matter what I think. It matters that 1,000 advised clients were very happy with their advisor. Okay, and I think this is partly because markets have been good. And so when you put cash and that you might not have earned much more than 1 or 2% on, and you've been earning, depending on the portfolio, 6, 8, 10%, they feel very much that their advisor has added value in that sense, and probably with tax planning in other areas. And interestingly, we ran this survey in 6 countries. So we did 6,000 clients, 1,200 advisors, and almost every country was around this number. Only the Swiss were a cynical 5.9%. The Germans were at 6.4%. So you have, lots of reasons to feel bullish about your business. So let's talk about the first big, 1.5% annual value, which is behavioral coaching. So these are things you'd be familiar with. Classic loss aversion, confirmation bias, herding, overconfidence, and anchoring. You probably know all about this. Anchoring, people will not sell their home for less than they paid for it. Right? That's a classic. And I've got 28 million real estate transactions to prove that point. Confirmation bias, it's what Twitter is built on. I believe something, other people agree with me, right? It's the algorithm, obviously, but confirmation bias is everywhere. Loss aversion is probably one of the most important of these behavioral biases. So you're there to kind of help people with some of these, biases. And of course, telling a client, listen, I saw a Vanguard presentation and it says that you're an idiot, is not a great way to sell, right? So some of this is about using neutral language and saying, well, we find that studies show people overtrade, you're not going to get paid to do that, and we have all the coaching aids to show you that. So we compared 58,000 investors, you can see in the footnote, for 5 years, who are in the Vanguard US system, who do it themselves. And we compared them to sort of simple benchmarks. They overtrade, and they give up between 100 and 150 basis points a year. Others, such as Morningstar and Oxford Risk, have put the numbers at much higher. And then again, Vanguard being Vanguard, they're like, you need to show more evidence. Okay. If you don't know this paper, Morningstar publish a piece every year called Mind the Gap. And what it suggests, or what it shows, is the difference between the fund category return and the investor return. So let me explain this. For the last 10 years, large growth on the left probably earned 12 or 13% per year. The investors in large growth funds who bought when those funds were doing well and sold when the funds were down earned 1% less than the 12% every year. Large value, they earned 80 basis points less, foreign large blend, mid-cap blend, etc. So what we see is that there is persistent difference between people buying high, chasing performance, FOMO, and at the bottom, GMO, get me out. And again, these are millions of transactions here, right? Every American fund category is classified over a decade, annualized. And again, don't trust me, read the footnote, have a look at the numbers. Are you familiar, since we're very few on the call, are you familiar with Cathie Wood and the ARK ETF?
Yeah, she shot the lights out during COVID and then hasn't recovered since.
He has a very famous product, the ARKK. It's the sort of active ETF. We can look at a 10-year track record from 2014 to 2024. Her product earned 9.7% per year. As you pointed out, it was volatile. What do you think investors in that product earned?
Oh, I mean, I'm sure many bought at the top and sold at the bottom, so it's going to be something very negative, I assume.
Yes. Anyone else want to have a guess? Go for it, JE. You want to try?
Not me. I hadn't even heard of it.
Okay. Well, was it more or less?
I would say less, like Robert said.
Yes, it is less. The answer is minus 17%.
How?
Yes. So by buying high and selling low, the investors in ARK for the 10 years ending 2024 earned minus 17%. So again, I'm not suggesting ARK is not a good fund. It performed worse than the S&P, fine, that can happen. But it had a point-to-point performance that was decent, 9.7% per year compounded. But because it was so volatile, people jumped on and jumped off at exactly the wrong time. So one of the big things, again, is this is less about having the perfect portfolio than it is keeping investors invested. And that's the behavior gap. So that's a huge part of the advisor's alpha. If we look now at asset allocation, the message here, again, is super important. A portfolio's movements, right, in a diversified portfolio are largely determined by asset allocation. Okay, so as a result, that is the thing to think about when you're doing risk, targeted risk for clients, etc. In a diversified portfolio, asset allocation is extremely important, and most clients are under-diversified. Okay, they have one job in one city, in one currency. They often, their biggest asset is an illiquid thing called a home, which they can't move, they can't sell a fraction of, etc. So getting people diversified and thinking about asset allocation is a big part of your value. Again, we have 124 years of history here for a British pound investor. And what we see here is a 100% bond portfolio to the left and a 100% equity portfolio to the right. If we take the beautiful Dutch color of 60-40, 60% equities, 40% bonds, what we see is the worst year in 124 years was 1974, down 38.5%. Funnily enough, it wasn't the Second World War. And the best year was up 101%. And the average return for this asset allocation mix was 7.6%. As you go from left to right, you add volatility, essentially. Right? Equities are more risky than bonds, and yet you have higher returns. There's nothing free in finance. Generally, it's a trade-off. The only free thing in finance is diversification. So here are the facts. So when a client says, listen, I want to earn 15% a year, one of the great answers is, okay, how? Because these are the 124 years of returns. Okay. And again, you might be familiar, I hope, with our jelly beans. The key point here is things move around. US stocks or North American equities in yellow have been very good for most of these years. UK equities in red, sometimes very good, sometimes very bad, etc. UK index-linked gilts have been a catastrophe the last few years. But if you were to try to rank these 10 asset classes, there are 10 asset classes in 10 years here, so there's 100 cells. If you sat with me at year end and you tried to guess correctly the next 10 in order, do you know what the odds are that you would succeed? So if you think of flipping a coin, that's 1 in 2. What would be the odds of successfully predicting these 10 asset classes in order? 1 in what? Go, JE, what was that?
10%.
10%, 1 in 10.
I think it's in 1 in hundreds of thousands.
Okay, 1 in hundreds of thousands. Anyone else? It's 1 in 3.6 million. Ask Claude how that comes about. But it's very important that you understand the odds of successfully predicting asset class returns in order are lottery odds. Again, not what your clients pay you to do, which is why you should be diversified. And then the Vanguard presentation wouldn't be a Vanguard presentation if it didn't talk about costs. So what we've done here is plot the 2019 asset weighted expense ratio, so the sort of what the assets paid on a 60-40 portfolio, 58 basis points in 2019, and the lowest cost paid 20 basis points, and the difference was 38. And I have a great news story. In the subsequent 5 years, clients and their advisors worked out that this was not a good idea and purchased lower cost. Costs are one of the best predictors of performance. And so the value of lowering costs is high, but of course it's lower than it was 5 years ago, 6 years ago, because costs have come down. And I'm not sure if you're familiar with the Vanguard effect, but when we enter a market, costs tend to come down across the board. Asset management's a very profitable business, and Vanguard enjoys bringing costs down for its clients and for advisor clients. We've lowered costs more than 100 times since we entered, the European market in the 2010s. We've lowered costs more than 2,000 times in the US because we're a mutual. And so one of the things I really want you to take away from this is American advisors and American clients in the last 15 years in equities have absolutely worked this out. All the flows are going to the lowest cost product. So you should think a bit less about active versus passive, active versus index, and more about high versus low cost. Cost is very, very important. You get what you don't pay for in asset management, and that's good for your clients. We have a couple of words here on practice management. I have an advisor, even though I spent more than 20 years on Wall Street and I know far more about markets than he does, that is not his job. My advisor, who took £12,000 up front, because I have such complicated, tax affairs, etc., has added huge value to my life, right? Even though I'm a financial professional. So why? Well, I think we spent about 30 seconds talking about my portfolio on a call with my wife. He said, yeah, markets did this. We own the market and we're going to rebalance back to your target allocation. And, we did this and this. But because the UK is such a difficult place, right? The asset location, right, is very important in putting things in exactly the right wrappers, as you all know. Protection's very important, right? Most of the time you don't need it, but when you do, you're grateful that your advisor made you do it. How many of your clients, I'm curious, don't have a will, do you think?
I would say like a quarter of them.
Yeah. I think if you can get people to do their will, you've earned your entire fee for the year.
All of our clients have wills.
What's that?
All of our clients have wills.
Good. It is absolutely crucial. And people think far too much about small changes in their asset portfolios and far too little about, left tail risk. I've been at Vanguard for 2.5 years. I've met thousands of advisors, and I hear obviously often the most dramatic stories of talking to widows, and really difficult things that you do as advisors. And having the right things in place for those tragic events is an enormous part of your value. And then, of course, there's a lot of wealth is tied up in private businesses, and how to think about that is very, very difficult. And I know we struggle with this sometimes, but the Chancellor, Ms. Reeves, has raised the value of financial advice. That's a kind way of putting it, but you need to think about it that way. Every time they change the rules, pensions, business property, all this stuff, these endlessly complicated rules that because you live them every day, you have a chance to help your clients. My father gave me a big gift, me and my brother, and I didn't even know that gifts taper after 4 years. The 7-year rule is unique to the UK. Okay. Again, there are things that you can do for clients that involve a lot of personal work. And again, that's very valuable. Okay. We think that the routine, the portfolio should be mostly outsourced and kept incredibly simple. Certainly, we see that in the US, where advisors run very large books and by and large make a ton more money than advisors in the UK. So I'm happy to talk more about that, given I spent 15 years there. This is from our Client Connect survey. Why do advisors get fired? Not performance. It's mostly service. When I bought a car last year, I don't drive, so my wife wanted to buy a car. I went to all these car dealerships and they tried to sell me this PCP thing. And I didn't understand what it was. Just to give you a sense, I've spent 20 years in finance. I have a CFA. Think I understand finance reasonably well, and I couldn't understand what they were talking about. I emailed my advisor in the middle of the meeting and I said, "What is this PCP?" And he said, "On no account should you do PCP." Of course, it's a sort of weird, bizarre scam. So advisors can do a lot by responding to their clients. Okay, I didn't understand PCP. They brought the manager out, and my advisor responded within 30 minutes to my sort of query. Answer your emails. Call your clients. That's the job. And I'm very grateful to my advisor for making sure everything's in one place. So as I said, I spend a lot, given my circumstances, on my financial advisor, and I think it's worth every penny. Our research, which, as I said, has 25 years of empirical data, suggests that the value is significant. It's not 3% every year, but it is 3% on average. So I'm going to take a quick stop there. Is there anything I should go back through again, or that's confusing? Anything that you found you want to debate further? Because I still want to talk to you through a very complex idea around, well, I'll try and make it simple, but the complexity of equity concentration.
I was just wondering if the 3%, so essentially you just deduct the ongoing advisor fee from that, and then it's would be 2%, as it were.
Depends what the advisor fee is. I mean, one of the big trends in the United States, just so you know, is that large networks are trying to raise fees from 80 basis points advice on average towards 120. The refusal rate is 3%. They are seeing enormous pricing power. I think it's for a couple of reasons. The richest, 10% of Americans have added 70 trillion in wealth, trillion with a T, which explains partly why Vanguard's business has benefited from all this. But the richest 10% have added 70 trillion since 2019. They are used to inflation. I think people underestimate this. Rich people are used to paying more, in particular for lawyers. Again, I don't know if you guys subscribe to the Wall Street Journal, but that's probably worth thinking about. It's a sort of $38 a month investment, not an endorsement, but something for you to think about. They write a lot about US wealth and what's going on. In the US, the top lawyers used to be $1,000 an hour, then $2,000 an hour, then $3,000 an hour, and there's a tier now between $3,000 and $4,000 an hour. Now, I realize you may not be working with ultra high net worth family office style people who spend, hundreds of thousands of dollars on legal fees every year, but I want you to be aware that there is an acceptance, piano lessons, pony lessons, I don't know, spending time at the Monza track for the weekend with Ferrari used to cost X, now it costs X times 2. There has been enormous inflation at the high end. Hermes handbags. I could just keep going here. There's so many areas. If you're not Again, always be skeptical of a man in a suit, but look up the cost of living extremely well index, which is also available. So I think advisors have more pricing power than they think, as long as they deliver the value. Right? In the end, actually, you're delivering peace of mind, time, and sort of well-being around money, succession planning, etc. You're not like delivering a portfolio. Portfolios are a commodity. I think this is a very important thing that often gets confused. What you do is difficult to scale. Everybody tries, right? With tools and back office, and let's lever this, and let's do more virtual calls, whatever. All absolutely fine. But in the end, I don't know how much you know of Baumol. Are you all familiar with Baumol inflation? Baumol inflation is a little bit more like advice. Baumol. Sorry, I'm going to give you guys a huge reading list after this. Apologies, but I figure if you're talking to me, it's because you want to hear things you haven't heard from hundreds of people at sort of various conferences. Baumol inflation is the fact that even though we have all this tech and the cost of tech has fallen, you still need 4 people to play a string quartet. You still need an advisor to sit down with a widow for an hour. And, I always say, you don't do 2 calls with 2 widows at the same time, right? It's a good way of getting people to focus on this problem. So I think it's important to explain that what you do is difficult to scale. What we do is much easier to scale. Okay. Now, again, go ahead. I wouldn't recommend any of you start an index fund business. It's quite hard work, and we think we know how to do it. But as a result, we're global. So are our competitors. If you give us another £1 billion, we will lower your fees, and we know how to do it. Right? It just goes in the fund. It buys the stocks market cap weighted, and we report, we rebalance, we trade. We know how to do it. It's much harder to scale advice. There are no global advice businesses. If you want to know who your threat is, let's see if it works. Your threat is a company called Creative Planning. Are you familiar with them, Robert?
No.
Okay, so you guys need to look up Creative Planning from Kansas City. They are the largest independent kind of wealth advisor RIA in the US. They manage north of $300 billion. And they have a London office. Okay, they're trying. But it's difficult. You still have to hire London CFPs and London experts, right? With us, when you give us £1 billion, some of it goes and is traded in the US where we already trade.
What do you think makes them unique?
Creative Planning, it's hard to know exactly the secret sauce, but they're certainly, again, the last numbers I saw, they had 2,500 people, or 3,000, sorry, 700 of whom do tax. They are very much on the advisor's alpha path. Again, I couldn't possibly tell you if they were a Vanguard client, but they might be, given that we run $4 trillion for advisors globally. It's a decent bet that most large advice firms will use Vanguard. They're just very, very good. Very, very personal. They've got a great CEO. They've done a lot of acquisitions, and they've talked about this. Maluk is the CEO, Peter Maluk. And they've grown a lot through acquisition and organically. And broadly, they were early on indexing, the core of the portfolio, and they were then early on privates at the edge, which is the classic US structure. You index the middle, keep it simple, low cost, get the market return, and then you have exciting private credit, private equity, venture capital, whatever. So have a look at Creative Planning. Again, you guys want to grow and be successful and see other things. So I'll close off Advisors Alpha there. And again, all these slides are available. Sunny is a great contact for you to talk to, and I'm around, as and when you see fit. Are we good to go towards equity concentration? Yeah? Okay. So here we are. And again, this will be, I hope, helpful and something a bit different to what you've seen. So these are the largest 7 stocks in the US by weight at the end of 2025. You can see NVIDIA there, obviously, on top, most valuable company in the world. And what we do here is we just go back and say, well, what did it look like as at end of year 2010 and 2000? A couple of things. Number one, only one company is present in all 4 columns. That's Microsoft. Apple, yes, is present in 3 of the 4, but Apple was almost bankrupt in 2000. You'll have to trust me. I was there. And then NVIDIA only IPO'd in 1999. So the index is highly dynamic, right? Things change, weights change, companies come in and out of favor, right? GE is a big dropout and has been a catastrophic stock in the last 25 years. But NVIDIA has seemingly come out of nowhere. Now, the top 7 add up to a lot more than they used to, and that's where we want to show you some context. So none of you, I suspect, are concerned about your Denmark fund, right? The top 10 stocks in Denmark, far left, are 80% of the Danish equity market. You know, wonderful companies, Novo Nordisk, Ørsted, and DNB, probably. ASML, Philips, right? Netherlands, Switzerland, 2 pharma companies and a bank, Nestle. Taiwan, this was last year, so it's probably gone up even more, TSMC. Germany, SAP. France, you know, BNP Paribas, Hermes, Kering, and LVMH. So every country has this. You know, do people ask you about their Denmark fund? No, right? The reason is you would never own a Denmark fund. You would own a global fund or a European fund if you want to be more concentrated. So you cannot.
Can I interrupt, Sebastian?
Sure.
You said this was the top 10 companies.
Yes.
Yeah. Thanks.
Yeah. Yeah, exactly. No, sure. And by the way, I think I mentioned, you know, footnotes are very important at Vanguard. We don't take them lightly. So anything that's a bit confusing, it should be in there and explained. The UK, again, AstraZeneca, a couple of banks, a couple of mining companies, BP and Shell, right? Every index looks like this. But of course, the way you diversify this is you go global. You add small cap. You make sure you own emerging markets. And that diversifies this risk. So we use an index quite a lot in the UK business and in Europe called the FTSE All World, okay, which includes emerging markets and has 4,246 stocks. The top 10 stocks in FTSE All World are roughly 25%. So the way you diversify this risk is you go more broad and you go more global. You still want to own NVIDIA and, you know, Amazon, etc. Fine. I don't know what they hold as a future owning, you know, as a future prospect. I just want to explain. You will therefore own whatever the next NVIDIA, the next Amazon is in a nicely diversified market cap weighted index. Now, let me show you again a little bit of context. And I'm going to speed through this next section, but I want to make sure you know about it. Number one, the top 10 stocks in the S&P 500 was almost 40% of the index in 1965. That then fell more or less for 30 years before rising again and then rising again. Okay, so that's the context. And our friends at S&P did this for us, which is helpful. The top 10 stocks at the time, GM, GE, GM, GE, AT&T, it's a sort of old school group. And as you can see, their weights subsequently fell. Okay, 3 of them even went bankrupt, Kodak, Sears, and GM. And we have loads of data on this. The point being that concentration in itself doesn't mean anything. It's just a sort of snapshot. And do you see a relationship here between concentration and the index performance? You're going to have to squint hard. Okay. The index has been obviously fabulous, the 500. That's no predictor of future performance, but the S&P 500 has been a very, very, very good, index performer for the last 60 years. And there's no relationship. And we can show you that with numbers. These are annualized price returns. That's why they're a bit lower, because they don't include reinvested dividends. But what you see here is, the decades returns on the left and the change in concentration on the right. And of course, what happened was that the dark line tumbling down are the sort of losers of 1965, the once great giants, and the new companies. Look at Apple, that beautiful teal color emerging, Nvidia emerging, because that's what the index is. It's a market cap weighted reflection of millions of decisions every day. And by owning them all, you get to own the winners of tomorrow. I mean, Meta is remarkable, right? Whatever you think of their products, Meta only IPO'd in 2012. So then we might, finish by just showing you S&P inclusion dates, again, for these top 10 stocks. So NVIDIA only entered the S&P 2 years after its IPO at 7 basis points. That's the second line. And it's, at the time, June 2025, it was 730 basis points. So it went up in weight 100-fold. And of course, the index went up as well. That's why it's been a good stock. And you can see Tesla, since people were asking about SpaceX when we got on the call, Tesla's an interesting one. The S&P 500 is not just a market cap weighted index. It also has very strict inclusion rules on a committee basis. And the committee said, listen, you need to be profitable, and only included Tesla years after its IPO. Performance would have been obviously even better had they included Tesla from IPO. But they have rules. So then you might say, well, listen, this is very interesting. I'm not sure what I should do about this. The answer, of course, is you should have a globally diversified equity portfolio, market cap weighted. But I'm here to tell you about something that you may not know about. Have any of you heard of the Besson-Binder study?
Yeah, it's the one where it's like 4% of stocks in the US are responsible for all the wealth creation or something like that.
Yes, I am making him famous, and you have helped me because that is correct. Besson-Binder is an academic, and he is at the Arizona State University, and he did something very special. He put together very long-term buy and hold returns of US stocks. And the work I'm going to show you, the first paper came out in 2018. It's been updated since. But essentially, the first question is, do stocks outperform treasury bills? 29,000 stocks studied. Every single stock born, died, merged, spun, everything in the US for 100 years. And the answer is remarkable. More than half of all these 29,000 stocks failed to beat T-bills, which are short-term government securities. And you might say, well, that's very surprising because equities beat bonds over time, right? Equity risk premium. Correct. But the equity risk premium comes from just 3.7% of all the stocks. Essentially, this is a superstar market. And the staggering number, I mean, just stunning, is on the right, which is that 46 companies produced half the wealth. That is just crazy. Let me repeat that. 46 stocks out of 29,000 produced half the return. That's a 100-year data set. So then you might say, well, show this to me graphically. And I'd say, you're welcome. Here it is. So think of this giant field, this haystack, and in a corner that you can't predict is all the value creation. You can start to see the portfolio construction problem. If you do not own these stocks, your odds of outperforming are very low. Forget outperforming, the odds of just keeping up. And 2 stocks, one of them a tobacco farm, created 10% of the US wealth. So here they are, the great stocks of the last 100 years. Altria Philip Morris took $1 in 1926 and turned it into $4.6 million. That's a 460 million % return over 100 years. It is the greatest of all time. Think about that. It also obviously has some ramifications for ESG portfolios. Right? Look at these stocks. There's defense on here, there's oil on here, there's tobacco on here. So you have to own all the stocks to get the best risk reward. That is a real issue for ESG portfolios. ESG portfolios, I've got no problem with people. Ethical investing is not new, by the way. The Quakers started it more than 200 years ago. But I think the important thing to understand is, by definition, the maths, it means that you will get a worse risk return, right? Because you are lowering diversification. Again, a lot of people confuse this because when oil was doing badly and tech was doing well, people equated ESG with good performance. They were just buying a factor fund. Again, I'm sure you wouldn't do this, but that's the sort of naive thinking that I unfortunately come across quite a lot. So let's step out. We've done 100 years, all the US stocks, 29,000 of them. Let me show you 1 year, because I think this positive skewness will intrigue you. So if you take the 503 stocks of the S&P 500 last year, in US dollars, they returned 17.9% market cap weighted, okay, top left. But the median stock, so half the stocks, returned more than 8.7 and half returned less. So what we do here is we break it down by return buckets. 2 of the 503 stocks fell more than 50%, far left. 33 fell between 25 and 50. 147 were flat to down 25. And you can see more than 2/3 of the index constituents underperformed the index. You see where you go from red to green. And what you get here is positive skewness. Essentially, the mean and the average, the average and the median don't really reflect the overall, because outliers matter a lot. Did you have a question? I know everyone loves a bell curve, but I'm happy to go through this because it's very, very important. I'm showing you 1 year because the 100 years is made up of years like this. Most stocks aren't very good, but some stocks are just exceptional. And of course, the challenge is owning the exceptional stocks, right? The risk of missing out, ROMO. And so one of the things that's interesting about stocks, completely different to bonds, stocks can only go down 100%. Now, that wouldn't be fun, but imagine that you and I are sitting at the turn of the century, and I say to you, listen, I want to own 2 UK retailers. I want to put £1 million in Next. I want to put £1 million in Debenhams. Okay, I want an undiversified portfolio, and heaven forbid, no rebalancing. Okay. And by the way, call me in 25 years. It's only £1 million, not a big deal. So we meet for tea at Claridge's, because I'm the kind of person who likes to meet at Claridge's. And I say, oh, how about that £1 million, £2 million portfolio we did for a lark? How did it go? And you like to play games on me, and you say, well, I don't know if you spotted it because you're busy, but Debenhams went bankrupt. So you lost your £1 million. And I'm feeling rather crestfallen. I think I won't not order the champagne with my tea. And then I say, well, how did Next do? And you say, well, I have good news. Next is up 50-fold. And I say, excuse me? 50%? No, 50 times. And I say, but Next is a retailer. The UK high street's been a disaster. And you say, yes, but Next is an exceptional retailer run by an exceptional CEO, Lord Wolfson. So it doesn't matter because he's exceptional. The company's exceptional. And exceptional companies can go to the moon. And I say, are there other examples like this? And you say, yes, of course. Loads of stocks do nothing, but plenty of them go up a lot, such as a Cardiff-based insurer called Admiral, which is up more than 30 times since its IPO in 2004, even though car insurance is not in itself a particularly brilliant business. So that's the very important concept. So I'm wrapping up here, but I want to make sure you see this. Like Britney Spears, Lesson Binder did it again and looked at 64,000 stocks for 30 years, exactly the same methodology. And sure enough, very similar numbers. In fact, more extreme, just 2.4% of stocks responsible for equities outperforming. And this is remarkable. Check out my graphics. just for those of you who can't do the maths in your head, 159 out of 64,000 is 1/4 of 1%. Very tiny corner of the field, a very tiny needle in the haystack, generated half the wealth. And this is incredibly important for your British clients. I assume you mostly work with British clients. These are the top 25. From the fall of the Berlin Wall to COVID, these were the great stocks that produced all, these wonderful results. The top 25 out of that 64,000. I hate to tell you this is kind of both depressing and invigorating. Not a single UK stock, not a single French stock, not a single German stock, not a single Spanish stock, not a single Italian stock. That's all of Western Europe. But there are 2 Swiss stocks, Nestlé and Roche. There are multiple emerging market stocks, Samsung, TSMC, Mutai, which is Chinese alcohol, Alibaba, Tencent. And very importantly as well, there are numerous stocks that came into the index quite late. Meta, 2012 IPO, MasterCard, 2006, Visa, 2008. It's almost as if, there was a huge party and these guys showed up late and the sound went up because they brought so much positive energy with them. So I think this is incredibly important. You own emerging markets, not because emerging markets have growing economies. Economies have nothing to do with the stock market. Remember, there are 2 stocks here, Nestlé and Roche, from a country with 9 million people, right? Nestlé is not got anything to do with the Swiss economy. It's irrelevant. But Nestlé sells Nescafe and Kit Kats around the world. Roche made enormous cancer, progress that it then obviously sold to the world. So again, GDP growth, GDP is irrelevant for stocks. Let me just repeat that because I often get people who hear the opposite. I can prove this, and if it's something that interests you, we can talk more about it. GDP and GDP growth is irrelevant for stocks. So as a result, you want to own emerging markets because there is a genius somewhere in emerging markets building the next Tencent, the next Samsung, the next Mutai. So you want to own as many stocks as possible because you get to capture the returns through diversification. Market cap weighted, obviously. Equal weighting is one of the worst strategies you can imagine, of course. And again, we use the FTSE All World here, 4,246 stocks. And you can see, again, you have this skewness. 56% of the 4,000 stocks underperformed. And you had this nice long tail that is typical of stock markets. Because again, stocks can go down 100%, but they can go up a lot. And this is the FTSE All Share, which again, you might be familiar with. I would, of course, never recommend a client own just 537 stocks in the UK. But I found this an interesting one, and we wanted to show you we're not just cherry picking. This is last year in Great British pesos. The FTSE All Share earned 23.9 market cap weighted. And again, 71% of the 537 stocks underperformed. But you had outliers such as Rolls-Royce and various gold equities, etc., etc. By owning them all, market cap weighted, you capture returns. Indexing is a means of capturing returns, not diluting. Essentially, because returns are concentrated, you must be diversified. So this is a power law. The top 1% of global stocks produce 80% of the wealth. It's not a US phenomenon. That's very important. People think it's US, it's tech. I am here to tell you that is wrong, and everybody's wrong. These are the numbers. They're just the facts. It's a power law. It's extreme. The UK has been a miserable stock index for 25 years. The UK without Next, the UK without Admiral is a sad, sad place to be. France without Hermès is a tragedy. Germany without SAP is just too sad to mention. I've seen a study recently, someone sent me from Germany, that SAP, the German software company, has produced 25% of German stock market wealth in the last 25 years. One stock. out of more than 700. Life is not fair, and returns are not evenly distributed. And again, I think this is also very interesting. We talked about the US, we talked about global. There is a new paper that you probably haven't seen, but it is available, and the footnote is there. 7,516 stocks in the UK, just 3% produced all the wealth. 50 years of data. And I hope none of you are running AIM portfolios, because AIM was a net value destroyer over 50 years. AIM was a value destroyer. And of course, our founder, Jack Bogle, had understood this. And that's why he's one of the most important figures in finance. So I hope that's been helpful, and that you feel challenged and provoked, and that you've seen something you've never seen from anybody else. I'm very open to questions if you have any.
No questions from me.
Thanks, Vincent. Pleasure.
Thanks, Sebastian. That was very interesting. Thank you very much. Yes, definitely different from some of the other webinars.
Maybe that's why Sunny made us connect. And as I said, the data is very clear. We're happy to share it all with you, and have it looked at by you and your teams. But it obviously has enormous consequences for equity portfolio construction.
Yeah, that'd be good.
And if you feel like hearing more, I don't know if any of you are podcast fans, but I recommend Rational Reminder, which is a Canadian podcast for two very thoughtful people in our industry. And they interviewed Besim Binder in episode 346. Because, it does feel like someone's just sort of said the earth is flat, which can be kind of it isn't, by the way, just to be clear. But it can feel a bit odd to hear this stuff. So I just want you to know that this has been proven numerous times. It isn't popular. It isn't popular because, of course, it makes active equity managers have to answer some very awkward questions, such as how do you deal with this problem? And so the active industry is obviously very profitable and very large still in the UK. And so I get, if I had £1 for every time people tell me it's the year of the stock picker, or it's the year of this, or the concentration is unsustainable. Yeah, listen, I worked with active managers for 25 years, so I know, and Vanguard has a large active business. We run 800 billion of active equity, but it's just important to understand the returns will come from very few stocks. That's just maths. So the question is, how do they do it? And that's a debate worth having. So I'm sure that given the England game yesterday, everyone might be a bit more tired. I don't know if anybody stayed up, but hopefully I've given you some things to think about. And as I said, always happy to follow up, and very grateful for Julian Harris and the team supporting Vanguard.
Thanks, Sebastian.
Thank you very much for your time.
Thank you. Bye-bye now. Bye.
Bye, everyone.
Thank you.
Bye.
Bye-bye.